Good morning and welcome to the weekly roundup for the week ending Friday the 8th of October. And just a reminder not to forget to subscribe to make sure you're alerted the moment our regular reports are released with the latest economic news and stock market content. Also, just a reminder about the Atlantic Capital Markets app that you can download onto your phones. Now, the app gives you a whole host of useful functionality if you're interested in the markets and want to keep abreast of what's happening both out there in the world and indeed of your own trading positions. In the meantime, any questions, please just pop them in the comments section below. We'd love to hear from you. Let us know the sort of things that you'd like to be hearing in these regular reports. Finally, we invite you to follow our free stock market reports on tech stocks, banking stocks and IPOs using the link in the descriptions below. So after Monday's steep stagflation-inspired sell-off, the market spent the rest of the week in recovery mode, rebounding higher off key supports and actually ended the week in positive territory. Energy markets have been in focus this week, and on Monday, OPEC Plus failed to hike oil output further than the already agreed 400,000 barrels per day level. At the same time, energy prices were surging owing to that ongoing energy crunch. Spiralling energy costs prompted the stagflation fears and speculation that the Fed could be forecast to raise interest rates sooner rather than later. Adding to the downbeat mood, politicians in Washington struggled to reach an agreement surrounding the US debt ceiling earlier in the week. Fast forward to Thursday and the dark clouds were actually easing. Washington did agree a deal to kick the debt ceiling can down that road until December. Russia also offered to intervene to send more gas to Europe, a move which immediately saw gas prices ease lower, cooling rate hike fears and boosting sentiment. Data-wise, figures from the US have been broadly upbeat, with the ISM services, the US factory orders and the initial jobless claims all coming in ahead of forecast. In Europe, the picture was less encouraging. The Eurozone reported weakness in retail sales, PMIs and German industrial data. Despite the weak start, the Dow is set to end the week over 1.2% higher, the Nasdaq 0.6% higher and the S&P 0.87% higher. In Europe, the FTSE is set to gain 0.7% higher and the DAX 0.6% higher. In the exchange markets, the US dollar is set to end the week 0.15% higher, its fifth straight week of gains. Now, the greenback has found support from upbeat data, boosting expectations of a move by the Fed, but also rising energy and oil prices, which have prompted bets that the Fed could be forced to raise interest rates sooner rather than later. On the other hand, the euro is on track to book losses in the region of 0.3%, and this will mark the fifth straight week of losses and takes the dollar-euro pair to yearly lows. Data from the Eurozone has been disappointing, with retail sales raising questions over the strength of the consumer-led recovery. Meanwhile, German industrial production and factory orders highlighted the impact that supply chain issues really were having. Meanwhile, the pound put in a strong recovery across the week, heading for gains of 0.5% against the dollar after 4 straight weeks of declines. There was no particular catalyst for the rebound. If anything, news surrounding Brexit were dismal, but a sense that sterling had been oversold seemed to help this reversal. In the commodities market, oil shot higher over the week, rising 3%, marking its 7th straight week of gains. The price hit a 7-year high after OPEC Plus agreed to stick to its output increase plan from July, which means lifting output by 400,000 barrels per day. There had been expectations that OPEC Plus may have lifted production, given that demand is set to continue and outstripping supply for some time, and given the tightness in the broader energy market. Other than that, gold is set to end the week 0.25% lower amid a better mood in the market. With equities and bonds in favour, of course, this does mean the safe haven precious metal falls lower. Gold is firmly focused on today's non-farm payroll report for further clues. In the stock market this week, Tesco surged 10% across the week after the UK's largest supermarket revealed that profits doubled despite the ongoing supply chain issues. Tesco offered reassurances that shelves would remain stocked over Christmas. The banks performed well across the week as rising energy prices prompted speculation of higher interest rates. Barclays was the top performer, up 3%. Meanwhile, NatWest came in just 1% higher after being slapped with a £340 million fine for money laundering failings. Over in the US, Facebook slumped 4% across the week, its fourth straight week of losses. Facebook came under pressure after experiencing an outage for 6 hours across its platforms on Monday. Facebook is also dealing with the fallout from whistleblower Frances Hogan, who is calling for more regulation of these tech giants. So that is it for the week. As always, thanks very much for watching. Please don't forget to subscribe and don't forget our very useful app if you're an investor. Get it downloaded right now. Finally, as always, if you have any questions, just pop them in the comments section below. In the meantime, from all of us here at Atlantic Capital Markets, have yourself a great weekend.